Hey everyone, Luke Gromen, FFTT. Hope everybody had a great holiday weekend here in the U.S. for Thanksgiving weekend. Hopefully get to see some friends and family, enjoy a little relaxation. I know we definitely did, but all of my boys were home. The two older ones at school, at college, were back in town, which is always a really nice family vacation, or family time together, which we really enjoyed. So with that, I'm going to jump right into the questions. The first one from Dan. At 4120 in this video, I asked Neil Kashkari, president of the Minneapolis Fed, whether the pivot happens when they can't service the debt. Do you think Congress decides the pivot rather than the Fed? I think it's a really interesting question. Ultimately, I do think the fiscal situation dictates here. It's ultimately a balance sheet capacity issue. And when I say that, what I'm talking about is the size of the U.S. fiscal deficit relative to the incremental global GDP growth. And whenever over the last 25 years or so, 30 years, that we have seen the U.S. deficit get too big as a percent of global GDP growth in dollars, the Fed has had to implement QE. We had a chart about this in recent tree rings, had a chart about this recent FFTT. They've done that every time except in 2022. And so when I say it's a balance sheet capacity issue, when you see what we saw in asset markets in 2022, which was dollar up, stocks down, bonds down, treasuries down, housing down, Bitcoin down, everything down, there's U.S. needs to finance deficits, and the government is not only crowding everything out, there's not enough balance sheet capacity to finance deficits, even though there was a big surge of private foreign demand for treasuries. De facto, it was not enough. Otherwise, the price of treasuries would have gone down, would have gone up. Yields would have gone down, and they didn't. So particularly in the second half, when in the first half of the year you could have made the case, okay, inflation's accelerating, you sell bonds. I get it. Second half of the year, you were seeing inflation roll over, you're seeing the economy roll over, and bonds still sold off, which is a sign that there was a capacity issue. So when we tie that back to the question of does Congress decide the pivot, we're now in a situation where the deficit is rising way faster than unemployment. The deficit is rising way faster than the pace at which inflation is coming down. And so I do think the fiscal situation as proxy for Congress can decide the pivot. Now, how could that come? It could come via political pressure. The Fed, we've all seen this chart of Fed remittance to the Treasury collapsing, massively negative now, right? So the Fed's still paying the banks. But they're really counting on more money from Treasury. You get that chart in front of the wrong congressperson from the Fed's eyes, from the bank's eyes, and it'll be a really interesting conversation. Why are we still paying the banks? Why is the Fed still paying the banks if the Fed's not paying us, the government? And that could be one way, conceivably, how the Congress could decide the pivot as a result of the fiscal situation. So let's see. From Tim, I'm persuaded on the debt, energy, inflation, etc. thesis, but I've been both certain and wrong before, as have I. You're not alone there. If you put your anything's possible hat on, how might they change the system to keep a lid on rates over the next 5 to 10 years? Regulate investors to hold bonds, capital controls? Yeah, they can do a number of things. Capital controls and regulating investors into buying bonds. So the regulating investors into buying bonds, that's already happened here in the United States. It started with bank HQLA regulations in 2014, buy more treasuries. Hold it as high-quality liquid assets in a crisis, which is something not a lot of people talk about yet. It hasn't mattered. It's probably not going to matter anytime in the immediate future. But in a severe crisis, high-quality liquid asset holdings for banks, if the banks need to sell these high-quality liquid assets in a severe crisis, guess what they're going to be selling alongside the Fed, the Treasury, foreigners, treasuries? It's very pro-cyclical in that regard. So you had HQLA regulations that mandated more bank treasury holdings. Then in 2015 and 16, you had money market fund reforms that mandated more treasury holdings. And so we've already had this, the beginnings of this regulate domestic audience into buying negative real rate treasuries. They could certainly do more with that. You could change 401k tax deductions or etc. You could just flat out mandate every single 401k's got to own 10, 20, 30% in treasuries, every single IRA, pensions, etc. You could do those things in theory. I don't think we are at that point. You could try a massive one-time wealth tax as a form of capital controls. Basically, you hear all these people say there's nowhere else to go besides the U.S. Use that to your advantage. Slap a giant one-time tax on. I don't think politically there's the wherewithal to do that yet, but that's something they could do if we're going to wear our anything's possible hat. You could drive economic collapse in the EU or in Asia to drive capital here to finance those deficits more cheaply. It's a lot like, sawing off your leg to try to lose weight. Nominally effective, but you bleed out pretty quickly shortly thereafter. But again, for our anything's possible hat, you can try to gain control of key energy resources globally, either via proxy, putting a new Yeltsin in Russia to replace Putin, or directly. That's our anything possible hat, but that gives you more control over energy to run that full out. That gets inflation down. If you can get an energy inflation down, you can manage keeping treasury bonds as good as gold for oil better if you control more oil. So there's a number of different things that could happen. The corollary to this is, look, if Putin is forced out in a coup and someone very Western friendly like a Yeltsin comes into power, that would force a major rethink in how we look at the world. Likewise, some of these other metrics, which have some puts and takes to them, etc. So nothing is written in stone. It's as it stands now. We feel pretty strongly about it, but there are a number of things we're looking for: economic, capital control, geopolitical, political, that would force changes to that. So you have to keep an open mind, and that's something we're trying to do. From I'm seeing strength in core industrials, for example, companies that make conduit, welding supplies, and heavy equipment. The wheels seem far away from falling off this train. Any thoughts? Yeah, it makes some sense. You've seen some infrastructure build. I would imagine heavy mining around electric vehicle metals is probably quite good. Demand for those types of pieces of equipment. You probably, I would think, have pretty substantial hurricane rebuilding demand going on in those sectors, some of those sectors. Energy production in the U.S. Is still quite high. In theory, maybe you're seeing on the margin some reshoring activity. I think the economy in the U.S. and more broadly is still very uneven. You're hearing some leading indicators, historical leading indicators, housing, multifamily, both weakening meaningfully in the non-cash buyer segments, right? So even within these, I was talking to a friend of mine the other day. Hey, the high end in a higher end area of the United States, $4, $5, $6 million houses, cash buyers are still there. Things where they are needing financing, that part of the market has slowed meaningfully, is what they were telling me. Leading indicators like South Korean exports, historically a very good leading indicator. They're recessionary. That's telling us what's going to come. So it's very uneven. I will say, from a personal standpoint, I recently put money into a private equity investment into electrical transmission and distribution equipment, which is not the sexiest industry in the world, but it's a very, I think it's going to be a very stable and very important with a secular tailwind, given EV, given infrastructure, given reshoring. And so, selfishly, to hear you saying that you're still hearing good strength in some of those related areas, that makes me happy to hear. From TM, if most, if not all, companies need to divest from manufacturing from China, where does that manufacturing go? Where, regardless of where, doesn't that represent a huge cost increase, building new plants, etc., and will pressure inflation for the next decade? I'm not convinced it all does have to leave China or will all leave China. I think it's important to note that I think 7 of the top 10 container ports in the world are in China. And it took them 20, 25 years working at the fastest pace in human history to do that. And so it's not going to easily be replicable, excuse me. And certainly, to your point, not without massive inflation. I do think you will see people leave, factories leaving China. I do think you'll see redundancies built. I think you're starting to see some signs of that when you talk about semiconductor fabs coming back to the U.S. Others obviously may leave. I think you'll see some go to Vietnam and elsewhere in Southeast Asia. But again, there's only so much you can go there. The infrastructure is just not there to actually just move the goods. You can build a factory, but you still got to get it on the roads, out of the country. And that, I think, is more of a lead time than people are giving credit for. Again, you can do it on the margins, but wholesale leaving China, I just don't think is likely. Some of it you'll likely see and are seeing it move to Mexico, Latin America. I've been told that that's more soft goods that have already been moving there anyway from a cost perspective. Some of it may come back to the U.S., as we were just talking about, particularly some of the stuff around national security, semiconductors, etc. But to your point, totally agree. In any case, it's all inflationary. Globalization was disinflationary, deflationary for labor. Deglobalization, I think, is going to be inflationary, and I think it's going to be very inflationary for labor. From RC, hi Luke, is the news about Ghana paying gold for oil important in your opinion? What can the USA do about it? I assume they don't like the development. And a related question from BY, how would an alternative gold or other asset-backed currency work as an alternative to the dollar? Who would trust a BRIC nation that issued this? So first off, in my opinion, yes, I think the Ghana news is important. It depends on the structure of how they ultimately do the deal, but it gives Ghana the ability to adjust their balance of payments as it relates to energy. And that, in that way, allows them to reduce their dollar outflows and manage their dollar reserves. It's going to depend on what ratio of gold to oil that they pay. In other words, if they change the gold to oil ratio relative to the open market, then suddenly that gives them another lever with which to manage energy imports. And since that's being done largely in dollars, that allows them to manage their dollar position. What can the U.S. do? I would imagine at least certain interests in the U.S. probably not happy with this arrangement. You could see the U.S. implement sanctions. That's the first thing you would see. That would be the first thing you see. So let's watch and see what they do there, both on potentially Ghana and then on the potential energy suppliers on the other side of that transaction, one of whom I suspect are already under sanction, and being Russia. So in my opinion, this gold is not going to be, or a gold or other asset-backed currency is not going to be an alternative to the dollar. I don't think anyone wants to back their currency with gold per se. However, I think it is and has been a growing alternative to treasuries, gold that is, as a primary reserve asset for the past 9 years. Since we put a chart on Twitter last week, and since 2014, global central banks have net sold on a net basis $371 billion in treasuries. They've bought on net $264 billion in gold. That's a $600 billion swing. That's starting to be pretty meaningful, particularly if at some point ever in the future we do get some sort of revaluation of gold, which I suspect is at some point only a matter of time, which ties into the last point, which is why that I think ultimately is happening, has to happen, is that in a peak cheap energy world, you have to reserve an asset that maintains its value in energy terms. It has to, if energy prices have to rise secularly in order to grow energy supplies as needed to continue to fuel the economic growth, to support humanity, to support the debt that we've taken on, then you're likely to see secular increases in energy prices over time. You can't hold as your reserve asset, if you're a country and an energy importer, Western sovereign debt that is going to fall in energy terms. You have to reserve an asset that will keep pace with the rise in energy, or else you're going to find yourself unable to afford energy. Your economy collapses, your currency collapses, your population collapses, you have political problems. This is why I think ultimately we've begun seeing, and now we're seeing an acceleration in this dynamic over the last 8 to 9 years, which is not buying treasuries on net, selling treasuries on net, buying gold on net at the global central bank level. Ultimately, gold can rise to adjust and maintain purchasing power of nations in energy terms. Western sovereign debt cannot raise rates enough to keep the debt stable in energy terms. At least they can't raise rates enough without bankrupting those same Western sovereigns. So with that, I'm going to finish up for the day. As always, thank you for joining me. If you like these updates, check out FFTT-LLC.com for more information about tree rings, 10 most interesting things, what grabbed our attention about those things, whether they are confirming or refuting a way we'd previously been thinking about the world, and can also check out what we're up to and other product offerings we have. So I hope everybody has a great week, and I look forward to chatting with you all soon. Take care, everybody.